There's an old saying that goes something like, while an investor has many reasons to sell, he almost always has only one reason to buy. If you haven't guessed it, then that one reason is obviously to make money. In that context, when a promoter increases his stake in a company, what he really means is that the company is now more valuable as compared to its current price. Understandably, this is a promising signal for any investor, and in this short and sweet video, we'll examine this very event as an investing strategy. I shall be leaning on articles, studies, data points, etc., a list of which is available in this video's description. But most prominently, I'll be borrowing from a detailed talk that was put together by Mr. Maran Govindaswamy of Unify Capital. And very aptly, this talk was titled, Indian Promoters Are the Best Contrarians. Let's begin. When one looks at Western markets, the US, Europe, Canada, Australia, there's a clear demarcation between ownership and management. Generally, it's institutions like hedge funds, pension funds, AMCs, insurance companies, etc., that own a heavy portion of shares in these companies, while professional managers are assigned the job of running the business and maximizing shareholder value. However, in Bharat, the owner and the management is more or less the same person. In fact, when we look at the top 500 companies, which is close to 94-95% of the total market cap, about 70 to 75% of the companies have a CEO or managing director who's either the promoter himself or is someone who is appointed by the promoter. In numbers, promoters by far have the highest chunk of ownership in terms of market capitalization, and it's a number that has vacillated between 45 and 55% over the last 10-15 years. Of course, this number varies from company to company. Some entities like TCS, ICICI Prudential Life Insurance, Adani Enterprises, DLF, etc. have a high percentage, 65, 70, 75% in promoter holding, while some other companies might have a low number, but the average across companies is more like 50%, which is quite a sizable number. I think this is very interesting because most of what we hear in the news or we find on Twitter, X, and I'm getting a little active on that platform, so do follow me. The point is, we receive a lot of information on FII holdings, what the foreign institutions or mutual funds are buying, while the biggest chunk of ownership is with promoters, and monitoring the increase or decrease in that number might give us a lot more valuable information on where things are headed. Okay, this next section is on how do promoters increase their stake in companies. Now, there are typically 5 ways of doing it. The first method is by buying shares in the open market, and while most promoters do this, they have to stay within the regulatory norms and also comply with other laws like the Takeover Act and the prohibition of insider trading regulations. Another way of acquiring shares is to do a preferential issue to a select group of investors like promoters, which can also be a super fast way of raising capital. Then comes warrants, which gives promoters the right to buy a specified number of shares at a predetermined price and within a set time frame. Of course, there are some regulations and rules here as well, but if the current share price is higher than the exercise price, then promoters will typically exercise their warrants, increasing their stake in the company. Number 4 is a rights issue, and I've explained this in greater details in a previous video, including the very interesting example of Sandur Manganese. If you haven't watched that yet, then please do so, as it covers something that a lot of retail investors miss out on, which can potentially lead to a loss of 30, 40, even 50%, as I explained in that video. And the fifth and final method is buybacks, and unlike the other 4, where the promoter has to commit some money, not participating in a buyback is an easy way for the promoter to increase one's shareholding. In fact, if you've subscribed to my newsletter, you would have come across a couple of buyback opportunities by TCS and Somani Ceramics, where as a retail investor, you can potentially make anywhere from 10 to 20% in profits over a single month. I'm looking at this newsletter very differently from a YouTube channel, and while the videos lean more on education, strategies, a broader set of topics in a YouTube channel, what's covered in the newsletter are more actionable and current money-making ideas. So do subscribe to it. The link is there in the description. And if possible, also get a couple of your friends to join in. Now, in addition to being an insider, the promoter is also a shrewd businessman who understands the importance of valuation. In other words, he'll buy when the odds are in his favor and he won't mind diluting his stake if the numbers are against him. We can see this clearly in this graph that when the mid-cap index was fairly cheap, so that's the whole of 2009 and of course the COVID months, April 2020 until December, in this period the highest amount of buying was done with promoters in more than 100 companies increasing their stake by at least 0.5% within a quarter. The exact reverse was seen when the mid-cap index had a massive run-up in 2016 and 17, and that's when promoters stayed away from making any additional purchase of stock. So there's an inverse correlation of sorts, and promoters generally stay away from buying when they see situations like very high mutual fund collections, so basically records are being broken, when FII inflow numbers are touching all-time highs, when the stock market returns are extremely strong, retail investor participation has increased, many IPOs are being launched, etc. In fact, far from buying, some promoters are known to cleverly dilute their stake by taking advantage of these high valuations. For instance, last year in April, May, June, when the markets, especially the mid and small caps, had touched all-time highs, promoters of 100 plus companies are said to have sold shares worth more than 16,000 crores in the open market. This includes promoters of HDFC AMC, Vedant Fashion, Coforge, TD Power, MTAR Technologies, etc., adding further weight to the contention that promoters are one of the best contrarian investors to follow. Of course, I should mention that no promoter knows the exact bottom or the highest high, but generally they seem to have a decent idea of when the chips are down and when valuations are too excessive. In fact, this phenomena is even more prevalent on a sectoral basis, and case in point is the FMCG sector, which did extremely well in the 2018-2019 period. Most of the stocks were trading at a P multiple of 50, 60, even 70, and while retail investors were happy investing, there was virtually no buying activity from the promoters. On the other hand, industries like auto, pharma, and metals did very badly during this period, and as you might have guessed it by now, one could see a significant amount of insider buying in these sectors. So is there a strategy in all this? You bet there is. And while I haven't seen it yet in a mutual fund, I did find one small case titled Top 10 Insider Trading. There's Mr. Maran's Unify Capital that has an insider shadow strategy. Edelweiss had, or maybe it still has, a Rubik PMS, and I'm reading the investment objective here, which says to build a portfolio of multi-cap companies where promoters are gradually increasing their stakes. And I see this theme at many places, including Neil Behel's Negen Capital, where the team is actively looking at promoter buying and terms it as smart money. To put a mathematical basis to it, I randomly pulled out 30-35 companies from different years where the promoter stakes had gone up by at least 3%, and sure enough, as a portfolio, this group of companies had performed exceedingly well with returns going 10-11% higher than the Nifty 500 index. In fact, I'll borrow a 15-year study that Mr. Maran and his team did, wherein they tracked companies where promoter shareholding had gone up. When the stock price performance was examined over 3-year periods, the team observed that about 11% of the companies hadn't moved, and they might have even gone negative, which means your experience as an investor was not that good. In 14-15% of the cases, the 3-year returns were hardly anything, single digits, so nothing much to boast about. And in 73% of the cases, the investor returns were quite substantial. He didn't exactly quantify that in his talk, but from what he said, it seems the returns were 20, 25, even 30% higher than what the index might have delivered during the same time. Mr. Maran further went on to add that the typical company where promoters increase their shareholdings have some common characteristics which speaks well of its financial strength. For instance, in a study, it was found that more than half of the companies, 56% of the companies where the promoter stake had gone up, had zero debt or a debt equity ratio of less than 0.5. This again substantiates what I've been saying all along, that shadowing the promoters as a portfolio strategy definitely merits our attention, as it not only gives us a better sense of timing, as we saw in the earlier section with promoters adding capital only when the odds are in their favor, and also what we have seen in this section with promoters committing their money only when the company is in good financial shape or is expected to be there over the coming quarters. But remember, this is not a firm rule, and there are cases, not many, but enough cases where the stock price continues to decline even after the promoters have increased their shareholding. There are also situations where after an increase in promoter stake, the stock doesn't do anything for 1, 2, even 3 years, which is why I think one should look at the strategy more as a portfolio rather than picking individual stocks. So do what you normally do. That is, extract a list of companies where promoter holding has gone up, let's say by 1%, conduct necessary checks on the P ratio, the ROC, the sales growth, free cash flow, etc. Shrink the list down to maybe 30 companies, then examine every company individually to determine which stocks have the highest chance of success, and finally bring the list down to 10, 12 companies that you feel comfortable investing into. You see, the point is promoters have proven themselves to be smart contrarian investors, and by simply shadowing their moves, I believe one can definitely make excess profits over the long term. I hope this video has given you some food for thought, and hopefully it acts as yet another evaluation point in your investing toolkit. If you like the content, then do give it a thumbs up. Do subscribe to my newsletter. Follow me on Twitter, or X as it is now called, and I'll see you 3 days from now. Until then.